You don't actually buy the house first. You always want to buy the money first. And the people who understand how money works typically pay off their house 12 years earlier than everyone else. I am Wale Lawal, a rental property investor based in Houston, Texas. I'm also a real estate broker who has helped hundreds of families to buy, sell, and invest in real estate. So I am talking from experience, and the strategy I'm about to walk you through, this is something I've also done on my rental property and my personal residence as well. I currently have over 30 rental properties, and I've implemented this strategy on 3 of my rental properties and my primary residence. So this is not a theory, this is a practical. And today I am pulling back the curtains of the ugly truth about mortgage interest that you are probably not aware of. And I will show you how to pay off your house 12 years earlier without refinancing or without draining your bank account. And here's what I'm going to cover with you in this video. Number one is how mortgage interest actually works so you can make a better decision with your money. I'll also explain to you why the system and why mortgage is actually built against someone like you. I'll also be sharing 4 major strategies you can implement today to cut off about 10 to 12 years off of your duration that it will have taken you to pay off your mortgage. I will also be covering the big debate of should you pay off your home early, or should you reinvest the money, or should you just stay in between. That and more I'll be covering in this video. So here is the ugly truth about mortgage interest that you are probably not aware of. When most people buy their house, they ask one question: can I afford the monthly mortgage payment? That is always the common question they always ask, and I can tell you that that's the wrong question. The question you should be asking is how much of this payment actually goes towards paying down my house, which is the principal. Because here is what your mortgage lender doesn't want you to know about or doesn't even want to discuss with you. Your mortgage payment you are paying every single month is front loaded with interest. On a $250,000 loan at 7% interest rate for 30 years, your monthly payment is about $1,666 every month. But the first month is about $1,458 goes towards interest only, and only $205 goes towards your principal, and principal is the amount you borrow. If you attack the principal, you will pay off your mortgage faster. So you see, you're not building equity by simply paying down the interest. You are feeding the bank, and by the time that 30 years loan is done, you've paid almost $600,000 in total. But you only borrowed $250,000 to buy the house, and about $348,000 has gone towards interest. So that's basically you buying the same house twice. So you might be wondering, why is it happening, and what is even this amortization they always talk about? So here is the game. Each month, the interest is calculated on whatever balance you still owe the bank. For example, you started with $250,000. That means you started with $250,000 loan. That is your balance as at the beginning of the loan. So at the beginning of the loan, your balance is huge, which means your interest charge are also huge as well. And that is why the early years, you are barely touching the principal at all. You are just paying them interest. The bank collects their money first. Anyhow you want it, they always want to collect their money first. But the seconds you pay down the principal faster, you instantly reduce how much future interest you will be charged by the bank, because again, attack the principal and you will pay less interest. So now that you understand how the system works, let's flip the coins and help you understand 4 major strategies that you can implement today to start paying off your mortgage faster. And if you do this correctly, this can cut off 12 years from the amortization. That is, a loan of 30 years can be paid off in as little as 22 years. And that will keep tens of thousands of dollars in your pocket, and that's the money that you can reinvest to your business or keep it as an emergency fund. Now, these strategies are extremely simple, and everybody and anybody can implement this strategy if you are disciplined enough to make it happen. The number one is the $100 extra towards your principal every single month. Now, the key word here is the principal payment. Don't attack it towards the interest. Pay $100 every single month towards your principal. Do this every single month and you will pay off your 30 years loan in as little as 25 years. And automatically on a $250,000 mortgage, you'll be saving $66,000 in interest over the course of the loan, and you did this in only 25 years instead of 30 years. So just remember, whenever you make the payment, make sure to label it apply to principal, not interest. Because if you don't, the bank will automatically apply it towards your interest instead of your principal. And that single sentence of you saying apply towards principal can literally save you 5 years of payment on your mortgage. The strategy number 2 is $250 towards your principal every single month. You see, if you can afford to go a little harder on yourself and you can pay extra $250 every single month towards your principal, you will pay off your mortgage in about 20 years. And this will save you roughly around $120,000 on a $250,000 mortgage in interest. And as you can imagine, this is like getting an instant 7% guarantee return on the debt that you already owe. You're simply attacking it a little bit faster. And this is happening because every dollar you pay early is a dollar that never accrue interest again. Now, this is a very common one. The strategy number 3 is to pay a lump sum of money towards your principal. I've personally do this and I've helped so many people to do the same. You simply want to get extra money into your principal every single year or every single month or every 6 months as you can afford it. Let's say you got your tax refund or you got a bonus from your job. So instead of spending it on luxury items or going on an expensive vacation, you can apply it towards your principal, and that will help you cut off several years of interest payment on your mortgage. Because if you simply apply $5,000 every single year towards your mortgage payment, that can save you about $28,000 on future interest you will have paid, because every payment made early do the most damage to the interest curve. The strategy number 4, which is also a common one, is what we call the bi-weekly payment. This one is a very sneaky, powerful one. You simply take your mortgage payment and split it into half. Let's say your mortgage payment is $5,000. Simply split it into half and you pay $2,500 every 2 weeks instead of paying your $5,000 every month. And because you are paying it every 2 weeks, that means you pay 26 half payments per year, and which equals to 13 full payments in a whole year instead of paying 12 payments if you pay monthly. Now, this one is very powerful because you barely notice any difference in your monthly payment, because all you have done is simply changing the how you pay it. Instead of paying it monthly, you're paying it every 2 weeks. And by simply doing this alone, you can cut about 6 years off of your mortgage interest you will have paid and save around $86,000 in interest on that $250,000 mortgage. Now, you can simply automate this by simply going to your online payment portal and set up your payment for every 2 weeks instead of every month, and you automate it once and for all and you forget it, and you just save yourself 6 years worth of interest payment. Now, before you do this, I want you to call your lender and ask them this question: can I make extra one principal payment on my mortgage every single year? You can also ask them, are there any prepayment penalties on my mortgage, which most of the conventional doesn't have any prepayment penalty. Prepayment penalty simply means that if you pay off your mortgage early, some bank can charge you extra fee for paying it early because they have not made enough interest on you. But most of the time, you don't have any prepayment penalty, but I will still ask your lender just to be on the safe side. Number 3 question you want to ask them is that, do I label it as it goes towards principal or it doesn't matter? I will still recommend, even if they say, no, it doesn't matter, I will still label it as applied towards principal. Now, here is where a lot of people will argue in the comment section, and I genuinely care about your opinion and your philosophy when it comes to should you pay it off or not pay it off early. As we all know, there are two camps of people: the team pay it off early or team invest the money. The team pay it off early, they want peace, they want freedom, they don't like debt, and they like to avoid risk at all costs. They are the kind of people that just love the philosophy of Dave Ramsey, and I don't blame them, because owning the house outright is emotional freedom, not just financial freedom. And here we have the team invest it. The team invest it will say, if mortgage is 5%, but I can make 8 to 10% in the money market, why should I pay off my 5% interest rate? And mathematically, they are not wrong. So here is my personal take on this matter. If your mortgage is high, I'm talking about 6% or more, then paying it off early basically means a guaranteed 6% return on your money every single month. Now, if your mortgage is under 4%, that is an asset. You might be better off investing the extra money into the stock market, into the retirement account, into another rental property, or just keep it as an emergency fund. So here is a quick reminder, especially if you are in Texas, even when your mortgage is gone, that is, you pay off your mortgage, you still owe property taxes and insurance every single year. So don't let your freedom number forget those two numbers. They are very, very important. Mortgage free doesn't mean payment free. You still have to pay your insurance and your property taxes every single year. So as you can see, the bank wants you to keep that loan for 30 years, but you don't have to give it to them. You don't have to do it the bank way. You can do it your own way. You want to start small, be disciplined, and be consistent with either $100, $250, or just a one lump sum payment every 6 months or every year, or simply a bi-weekly payment plan. By switching your mortgage payment from monthly to bi-weekly can save you up to 12 years off of your mortgage payment duration. And this will also put thousands of dollars back into your account, back into your pocket, and these are money that you will have paying interest otherwise. Now, the earlier you start, the faster the compounding interest curve will break. And if you want all my mortgage hacks and other real estate strategies that can help you save a lot of money on your mortgage payment, I invite you to join my free online community of like-minded people where we are on the same path, building wealth through real estate. You will see the link in the video description below. So before you go, I want you to watch this next video on how you can turn your own into a rental property and buy another one this year. Because paying off your mortgage is a smart move you should do, but using the cash that you save from there to build wealth is another thing that most people always overlook. So I don't want you to overlook it. Watch the video here. I put a lot of value there and I'm sure you'll find it very helpful. So make sure you don't overpay the bank, and I will see you in this video. Peace.